Welcome back to the deep dive.
Great to be here.
Today, we're plunging into a really fascinating market intelligence report. It's from August 11th, 2025. And our sources, they actually describe that day as the Great Pause.
That's a great description. It really captures the mood.
It really does, because
Yeah.
this wasn't a day, characterized by precisely. Because just around the corner, I mean, literally the very next day, August 12th, two critical intertwined events were looming large. They were casting this long shadow over trading floors everywhere. First, the release of the U.S. July Consumer Price Index data, the CPI.
Which is, of course, a major gauge of inflation, something everyone was watching like a hawk.
Absolutely. And second, the expiration of a really crucial 90-day U.S.-China trade truce.
Uh-huh. High stakes on both fronts.
These weren't just, dates on a calendar. They felt like potential inflection points for the global economy. Big turning points, possibly.
What's so fascinating here, as you said, is that the day's dynamics, August 11th, were genuinely characterized by this fundamental tension. It was almost like a tug of war. On one side, you had this kind of lingering bullish momentum, a carryover, really, from a surprisingly robust second quarter earnings season.
Yeah, those Q2 numbers were pretty strong, weren't they?
Yeah.
Better than expected.
Much better. Corporate profits had decisively beaten expectations, quite significantly in some areas. So many investors felt a sense of relief, maybe continued optimism from that.
Okay, so that's one side, the positive momentum.
But then, on the other side, there was this pervasive anxiety, and it was centered squarely on the persistent threat of stagflation.
Ah, stagflation. That word always makes people nervous.
And for good reason. That toxic combination of slowing economic growth coupled with stubbornly high inflation. It's the worst of both worlds for policymakers and markets.
Right, and then you layer on top of that the U.S.-China situation.
Exactly. The high-stakes diplomatic maneuvering involving the U.S. and China add this whole other layer of deep uncertainty. What would happen when that truce expired? Nobody knew for sure.
So it really wasn't a day of decisive action in the markets, was it?
Not at all. It was much more about significant signaling. Every slight move, every tick up or down, seemed to carry extra weight. People were reading the tea leaves, so to speak. It really revealed a market that was acutely sensitive to policy shifts, both from the Fed on inflation and potentially from governments on trade.
And increasingly intolerant of growth disappointments, maybe.
Yes, absolutely. Especially outside of certain key sectors we'll get into. The market seemed positioned at this really crucial inflection point. So I think the key takeaway right off the bat here is that sometimes a quiet market isn't a complacent one. It's a market holding its breath, highly sensitive to even whispers of policy shifts and data releases.
That's a powerful way to frame it. Okay, so let's unpack this great pause a bit more, starting with a global snapshot. Looking at the U.S. major indices, the S&P 500, the Dow Jones Industrial Average, the NASDAQ Composite, they all saw modest losses on August 11th. That's pulling back slightly.
Yeah, small dips, nothing dramatic.
They'd hit near record highs just the week before, so this pullback, it really does feel like what you might call a consolidation phase, or maybe just a holding pattern.
That's precisely the dynamic we observed. And I think that cautious tone was predominantly driven by traders just being, unwilling to take on significant new risk. They were essentially sidelined, just waiting for clarity. Clarity from the CPI release, what would inflation look like, and clarity from that trade truce expiration deal or no deal, extension, tariffs back on.
Too much uncertainty to make big bets.
Exactly. There was very low conviction in the market. Nobody wanted to make a big directional move right before such critical macroeconomic data and geopolitical developments. The potential for whipsaw volatility, getting caught on the wrong side of a big move, was simply too high.
Makes sense. It was a classic wait-and-see approach then, just amplified maybe by the sheer scale of these two looming events happening simultaneously.
Amplified, definitely. The confluence was key. It wasn't just one thing, it was both things, hitting at almost the same time.
Okay. And it wasn't just the U.S. markets holding their breath, though our pause here was pretty prominent. You mentioned the global picture was quite mixed. Underneath the surface calm, different currents were flowing worldwide.
That's right. It wasn't uniform caution everywhere.
For instance, Japan's Nikkei 225 saw a pretty significant gain that day, up 1.85%. That seems counterintuitive given the global tension. What might have driven that, even as the U.S. nudged down?
Yeah, it's an interesting contrast, isn't it? While U.S. markets were really focused inward, digesting their own domestic anxieties about the Fed and inflation, plus the China situation. Japan's market often responds to its own specific local factors. It could have been positive corporate earnings reports released earlier that day or the day before, or perhaps expectations around Bank of Japan policy, which, sometimes diverges quite significantly from the Federal Reserve's stance. Maybe there was a perception that Boji would remain accommodative.
So local factors trumping global worries, at least for that day in Japan.
It's a good reminder, I think, that even in our incredibly interconnected world, local catalysts, domestic policy, specific company news can still drive distinct market outcomes. Not everything moves in lockstep all the time.
Okay, what about China? Given the trade truce deadline was directly involving them.
Well, China's Shanghai Composite and Hong Kong's Hang Seng also registered modest gains that day. Not huge, but positive. This likely reflected some hope, perhaps some cautious optimism of a positive resolution to the looming trade discussions. Maybe whispers of an extension or just relief that things hadn't blown up yet.
A bit of hope clinging on there. And Europe?
Europe was more mixed, reflecting its own set of concerns. The UK's FTSE 100 was up slightly, about 0.40%. The FTSE is often influenced by commodity prices, which were holding up okay and maybe some specific UK stock news. But Germany's DAX and the broader Euro Stoxx 50 were actually down slightly, minus 0.11% and 0.19% respectively. This likely reflects broader Eurozone concerns about economic growth momentum, maybe lingering inflation worries there too, particularly impacting their large industrial sectors. Germany, especially, is sensitive to global trade and manufacturing cycles.
So it's not just interconnectedness, it's almost like a fractal market. Global trends play out, but local factors, regional worries, they still paint distinct pictures within that larger canvas.
That's a fantastic way to put it. Fractal market, global themes, local variations. That was certainly the picture on August 11th.
And this texture, this complexity, it extended across other asset classes too, right? Beyond just stocks. What else caught your eye in the data from that day?
Indeed. Looking beyond equities gives us more clues about the underlying sentiment. For instance, we saw WTI crude oil up by about 0.58%. Not a huge move, but positive.
What does that typically signal?
Well, it often indicates either a perceived increase in global demand expectations, maybe signs the economy isn't slowing too dramatically, or perhaps ongoing supply concerns. These could stem from geopolitical tensions somewhere else in the world, unrelated to the U.S.-China issue, or even anticipation of policy decisions, like OPEC plus moves, that could impact future energy supply or use. So oil was holding relatively firm.
Okay, what about gold? Usually in times of uncertainty, people flock to gold, right? The safe haven?
You'd think so, but interestingly, gold was actually down about 1.20% that day, which is quite notable given the general anxiety we've been talking about.
Down. Huh. Why would that be?
It could suggest a couple of things. Perhaps while there was caution, there wasn't a full-blown panic, a complete flight to safety where everyone just piles into gold. Or perhaps more likely, it was related to the strengthening U.S. dollar.
Ah, the dollar. Tell us about that.
Right. The U.S. dollar index, the DXY, which measures the dollar against a basket of other major currencies, strengthened by 0.40% on August 11th.
And a stronger dollar often means weaker gold.
Often, yes, because gold is priced in dollars globally. So a stronger dollar makes it more expensive for buyers using other currencies. That can dampen demand.
Okay, so the dollar was up. What does that tell us?
A strengthening dollar in this context often happens when investors perceive the U.S. economy or U.S. assets as a relatively safer haven compared to other regions, despite the domestic worries. Or, perhaps more pointedly, it could reflect anticipation that the Fed might have to maintain a tighter monetary policy stance, keep rates higher for longer, especially if that upcoming CPI data came in hot. Tighter policy tends to boost a currency.
Compared to other central banks, maybe.
Exactly. Compared to, say, the European Central Bank or the Bank of Japan. If the Fed looks more hawkish, the dollar tends to strengthen.
And that strength would then ripple outwards.
Precisely. When the dollar strengthens, it means currencies like the euro and the British pound typically weaken against it. And indeed, we saw EURUSD and GBP/USD both move lower that day. So these movements in cross-asset performance oil holding up, gold dipping, dollar strengthening, they provide these really crucial insights into the global mood, even on a seemingly quiet day. They hint at these underlying pressures, investor preferences, and maybe conflicting narratives playing out simultaneously. It's rarely a simple, unified story.
Fascinating how you can piece together the sentiment from all these different indicators. Okay, now let's get to what you call the earnings season paradox. This is where the story gets really interesting, I think. Because on the surface, as you mentioned, the second quarter of 2025 earnings season looked like a resounding success, a real blowout.
It really did, looking at the headline numbers.
S&P 500 profits, according to the report, were on pace to grow somewhere between 10.4% and 11.4% year over year.
Which is a huge number.
Huge. Especially when you consider that the initial estimates going into the season were way down in the 2.8% to 4.8% range. So actual results just blew past those initial forecasts.
Absolutely crushed them.
And not only that, but a stunning 81% of the S&P 500 companies that had reported by then actually beat their earnings per share estimates, 81%.
Which is well above the typical 5-year average beat rate, something usually in the mid-70s. So a very high beat rate, too.
So on paper, I mean, doesn't that sound like a booming economy? Strong profit growth, companies exceeding expectations. What's your take? Does this truly reflect the health of the broader economy? Or is something else going on?
That's exactly the question. And it really is the crux of the paradox. Because while those aggregate numbers at 10-11% growth and the 81% beat rate are genuinely impressive, this is precisely where that idea of a dangerous concentration comes into play. That surface-level strength, it masks a critical underlying issue.
Okay, dangerous concentration. Tell us more.
The bulk of this growth, the primary engines that were really driving that impressive S&P 500 average, were overwhelmingly concentrated in just two sectors: information technology and communication services.
The tech giants and related companies.
Precisely. Both of those sectors posted absolutely stunning year-over-year earnings increases. We're talking over 20% growth for both. Just incredible numbers.
Wow, over 20%. And why such huge growth there?
Well, the analysis attributes this incredible performance largely to the massive investment pouring into and the pervasive optimism surrounding artificial intelligence, AI.
Yeah, AI.
It truly seemed to be an AI-driven surge. Companies involved in chips, software, cloud infrastructure, platforms leveraging AI, they were seeing phenomenal results, or at least investors believe they were seeing phenomenal results in potential. And the critical point is this: without these two high-flying sectors, the overall S&P 500 earnings growth picture would look dramatically different, much, much weaker.
Right. So if tech and communication services were soaring, fueled by AI, hope, or reality, what about everyone else? Were other sectors just treading water? Or worse?
That's the stark contrast. In stark contrast to tech and comm services, sectors like materials, energy, utilities, and even consumer discretionary logged the lowest rates of earnings beats.
Materials, energy, utilities, consumer discretionary. Those sound like pretty fundamental parts of the economy.
Exactly. These are often more cyclical, more tied to the traditional economy. And the fact that they had the lowest rates of beating expectations is a very clear signal. It signals broader economic weakness, maybe even contraction, outside of those specific high-flying tech and AI-related areas.
Can you give us a bit more color on why those specific sectors might have been struggling?
Sure. Take materials, for example. That sector often struggles when global manufacturing output slows down, or when commodity prices become volatile or decline. It's very sensitive to industrial demand. Energy, well, despite that slight bump in WTI crude we saw on August 11th, the sector overall has faced ongoing demand uncertainties, price fluctuations, and maybe pressures related to energy transition policies that can hit profitability compared to boom time.
Okay, utilities. They're usually seen as stable, defensive plays.
Typically, yes. They're less volatile, but lower overall economic growth can still impact electricity demand, for instance. And regulatory issues or rising input costs can also pressure their margins. They weren't collapsing, but they weren't showing strong growth beats either.
And consumer discretionary. That seems important. Things people choose to buy.
Very important. This sector relies heavily on consumer spending power and confidence. The fact that it was among the laggards suggests consumers might have been feeling the pinch, perhaps from inflation eroding their purchasing power, or maybe worries about the economic outlook making them cut back on non-essential goods and services.
So putting it all together,
it indicates that while this incredible innovation and optimism around AI is driving massive profits and investment in one, albeit large, segment of the market, many other fundamental cyclical parts of the economy, manufacturing, energy, basic consumption, seem to be struggling to keep pace. It points towards a more uneven, perhaps less robust economic foundation than those headline earnings numbers might suggest.
a two-tiered economy almost. Tech booming, traditional economy lagging.
That's a good way to think about it, a significant divergence. And what's fascinating, just adding another layer here, is that despite this broader weakness in, say, consumer discretionary, even on that specific day, August 11th, the report noted there was still noticeable buy-side pressure in both consumer discretionary and technology stocks.
Really? Even with the discretionary showing weak earnings beats overall, why would investors be buying there?
It suggests that investors were being very selective. Perhaps they were deploying capital into specific companies within those sectors where they still perceived strong growth potential, maybe specific brands or tech-enabled retailers. Or it could hint at this kind of flight to quality within growth sectors. If you feel you have to be invested in growth, maybe you stick with the perceived winners in tech and discretionary, even if the broader sector signal isn't uniformly positive. It shows how complex investor behavior can be.
Very nuanced. Okay, this concentration you described, this two-tiered picture, it leads us directly into what are sources and what we're calling here the great tech divergence. You've already touched on it, but let's really focus here. Because it seems like a profound and maybe structural issue, this widening chasm, this gap between the technology sector's soaring market valuation and its actual proportional contribution to overall corporate profits.
Yes, this is, I think, one of the most critical takeaways from that period and something that likely has implications far beyond just August 11th, 2025.
So given this divergence, the question becomes, is the market perhaps getting a bit ahead of itself on tech? Are valuations becoming detached from underlying fundamentals? And what are the potential implications for other sectors and the broader market if that's true?
It absolutely raises that question. Is the market truly valuing the tech sector based on current tangible profits? Or is it overwhelmingly betting on future potential, on innovation breakthroughs, particularly around AI, that haven't fully materialized in the bottom line yet for the whole economy?
And the data points you have really highlight this, right?
The data is stark. The most critical data point revealing this trend, this disconnect, is undeniable. Let's look at the time frame from roughly late 2022 up to that point in August 2025. Over that period, the information technology sector's market capitalization, its total stock market value, as a share of the entire S&P 500's total market cap, it ballooned. It went from approximately 22% to over 32%.
Wow, from 22% to 32% of the whole S&P 500 value. That's a massive increase in market share. Investors were clearly pouring money into these tech companies, driving up their prices relative to everything else.
Huge shift in weighting. But, and this is the crucial but, during that exact same period, late 2022 to August 2025, the tech sector's share of the S&P 500's total net income, its actual contribution to the overall profit pool, it only edged up slightly, from around 21% to about 23%.
Okay, wait, let me make sure I and our listeners grasp this. Market value share jumps 10 percentage points from 22% to 32%, but profit share only moves 2 percentage points from 21% to 23%.
Exactly. Think of it like this. Imagine the S&P 500 is a giant pie representing the total value of the biggest U.S. companies. The slice representing tech got way bigger, over a third of the pie's value. But now imagine another pie representing the total profits earned by all those companies. The slice representing tech's profits, it only grew a tiny bit. It's still less than a quarter of the profit pie.
So the price investors are willing to pay for that slice of the pie has grown way faster than the actual earnings that slice is generating.
Precisely. The market is betting heavily, incredibly heavily, on future potential, on future profit growth that hasn't shown up proportionally yet. The current fundamentals, the actual profit generation today, aren't keeping pace with the soaring valuations.
That is a huge disconnect, a key nugget, as you said earlier, for you, the listener, to really understand.
It really is. It tells us that the market is assigning a significantly higher value, a much higher price-to-earnings multiple, essentially to these tech companies compared to the rest of the market, and much higher than their current proportional contribution to the S&P 500's total profits would seem to justify based on historical norms.
What are the implications of that? Does it matter if valuations run ahead of current profits for a while?
Well, it creates potential risks. The most obvious is market concentration risk. If a relatively small number of these high-flying tech companies are driving most of the aggregate market returns, most of the S&P 500's gains, then the broader market becomes much more vulnerable. If there's any kind of correction, any slowdown, any sentiment shift specifically in that tech sector, maybe AI enthusiasm cools or regulatory hurdles appear, it could have an outsized negative impact on the entire index, dragging everything else down with it.
Because they become such a huge part of the index's value.
Exactly. It makes the market less diversified in practice, even if the index technically holds 500 companies. It also suggests that while the headline market indices and maybe even aggregate earnings might look healthy, the underlying health of the broader economy, the non-tech parts, might be significantly more fragile than those top-line numbers suggest.
A potential vulnerability hiding in plain sight, masked by the success of a few key players.
That's one way to interpret the divergence, yes. It warrants caution and deeper analysis beyond just the surface numbers.
Okay, so we have this picture. A market paused in anticipation, surprisingly strong headline earnings driven almost entirely by tech, leading to this major divergence between tech valuations and tech profits. Now let's pivot back and bring in the other major factor contributing to this great pause on August 11th, that geopolitical undercurrent, specifically the expiration of the 90-day U.S.-China trade truce the very next day.
Right. This wasn't just background noise. It was a massive elephant in the room for many traders and businesses.
Can you remind us briefly of the context here? What was this truce about?
Sure. To understand the weight of this deadline, it's helpful to remember the context leading up to it. This 90-day truce had been established essentially as a temporary ceasefire in what had been a pretty escalating and damaging trade war between the world's two largest economies. That trade war was characterized by these tit-for-tat tariffs being slapped on hundreds of billions of dollars worth of goods flowing between the two countries.
Right, hitting everything from soybeans to electronics.
Exactly. The original purpose of this specific 90-day truce was to pause those hostilities, to prevent further escalation, and crucially, to allow negotiators from both sides time to sit down and try to hammer out a more comprehensive, longer-term trade agreement. They were meant to be tackling the really thorny issues, things like intellectual property theft concerns, complaints about forced technology transfers, market access barriers for foreign companies in China, and the overall trade imbalance.
So a lot riding on those 90 days of talks.
A huge amount. And as August 12th loomed, the deadline for that truce, the stakes were incredibly high. What would happen? Would they announce a breakthrough deal? Would they agree to extend the truce to keep talking? Or, and this was the big fear, would the truce simply expire with no agreement?
And if it just expired, what was the market worried about?
The fear was the immediate reimposition of those tariffs that had been suspended, possibly even escalating them further. That would likely spark a renewed, intense phase of the trade war.
Okay. And how would that manifest in the markets? What specifically were traders anticipating or worried about?
Well, the reimposition of tariffs would have very direct, tangible impacts across various industries. For instance, U.S. agricultural exports to China, things like soybeans, pork, which might have seen a slight recovery during the truce period, could plummet again, directly hurting American farmers and agricultural businesses.
Okay. Ag sector impact. What else?
Technology and manufacturing supply chains. These are already incredibly complex and deeply intertwined globally, especially between the U.S. and China. Renewed tariffs would mean severe disruption, increased costs for components, potentially forcing companies to urgently reconsider their sourcing strategies, their production locations. A massive headache.
Huge uncertainty for business planning.
Exactly. That uncertainty directly impacts corporate investment decisions, hiring plans, and ultimately investor confidence. Sectors seen as particularly reliant on global trade, and those complex supply chains, think semiconductors, automotive manufacturers, heavy machinery companies, would be especially vulnerable to negative news.
Makes sense. Well, what if the news was positive? An extension or a deal?
Conversely, if an extension to the truce was announced, allowing talks to continue, or even better, if they surprised everyone with some kind of interim or comprehensive deal, that would likely provide a significant boost to market sentiment. It would remove a major cloud of uncertainty. Multinational corporations with global footprints and commodity markets sensitive to global growth perceptions would likely rally strongly on that kind of news.
So really binary outcomes possible almost. Deal or no deal, extension or escalation.
Very much so. And that's why this confluence, the macroeconomic uncertainty stemming from that upcoming CPI data, potentially influencing Fed policy, combined with the geopolitical uncertainty of the trade truce outcome. That's what truly created that holding pattern we discussed earlier. Traders really did prefer to simply sit on their hands, await clarity from both these major fronts, before committing any significant capital. The potential outcomes were just so vastly different, pulling in opposite directions. Making a big bet felt like gambling.
It really highlights, doesn't it, just how sensitive markets are to policy shifts, both monetary policy and trade policy.
Absolutely. And it shows how different, seemingly disparate factors, domestic inflation data on one hand, international relations and trade negotiations on the other, how they intertwine, how they interact to shape overall market behavior and sentiment. It creates this incredibly complex web of anticipation and reaction.
Wow. Okay, we've covered a lot. The pause, the underlying tension, the earnings paradox, the tech divergence, the geopolitical shadow. So let's try to synthesize this. What does this all mean for you, our listener, as someone trying to stay informed, trying to make sense of the daily market headlines? When you see reports about market performance, maybe a day where the indices didn't move much, like August 11th, 2025, how much should you be looking beyond just those surface numbers?
That's the critical question, isn't it?
What stands out to you now, thinking back on that day, about the signals these markets are sending, especially when the overall picture seems calm, like on August 11th, but these powerful undercurrents are swirling, driven by things like critical inflation data releases and complex international relations?
I think it profoundly raises an important question for all of us, whether you're a professional investor or just someone trying to understand the economic landscape. In a world where we're seeing increasingly concentrated growth, perhaps driven disproportionately by just a few sectors like technology, or maybe a few key themes like AI, how do you truly evaluate the health of an economy or a market?
Is looking at the average enough?
Exactly. Is it enough to simply celebrate aggregate earnings growth, which might look strong on paper, like that 10–11% we saw in Q2 2025? Is it enough to just glance at the headline index numbers, S&P up, Dow down slightly? Or must we always dig deeper? Do we need to really look into the distribution of that growth? Examine those underlying structural issues, like the great tech divergence between valuation and profit share we discussed. Do we need to understand those nuances to truly grasp where we're really headed?
It sounds like you're arguing for the dig deeper approach.
I believe that great pause on August 11th, 2025 serves as a powerful case study. It truly demonstrated a market that was acutely sensitive to policy shifts, watching the Fed, watching Washington, watching Beijing. It showed a market that seemed to be becoming increasingly intolerant of growth disappointments outside of its key favored drivers, particularly tech. And it really felt like a market positioned at a crucial inflection point, waiting for the next major signal.
A quiet day that spoke volumes in its own way.
Absolutely. It profoundly showed us how interconnected everything is, from domestic inflation numbers influencing monetary policy to geopolitical gambits impacting trade flows and confidence, and how all these threads weave together to shape market behavior, even when the surface seems still.
That's a really powerful thought to end on. The great pause wasn't emptiness, it was fullness. Full of anticipation, underlying tensions, and these critical divergences. A perfect illustration that even on a seemingly quiet day, the market is constantly signaling, often in subtle but incredibly significant ways.
The key is learning how to read those signals.
We hope this deep dive has helped you, our listener, understand those signals just a little bit better. Maybe equipped you to look beyond the headlines next time the market seems unusually calm, and to appreciate the complex forces that might be swirling just beneath the surface.
Keep asking those deeper questions.
Absolutely. Keep digging into the topics that matter to you. Thank you for joining us,
Thank you.
and we'll see you next time on The Deep Dive.